Welcome to the Hurst Trading Room. This is our video update for the 11th of March 2013. As always, before we move on to the markets, please make sure that you have read and understood our disclaimers. Let's take a look at the markets, and we'll start with the S&P 500. Now, as you know, there are two possible analyses that I believe might be playing out in the S&P 500, and the analysis that I've been tracking and making trading decisions on the basis of is this analysis that you can see, which places an 18-month cycle trough over here in the middle of November. So that's 18 months, and we could debate that. We could say maybe that was only a 20-week cycle trough. Indeed, it might have been, and certainly that's the analysis that I present at the moment in the blog, which therefore considers that the 18-month cycle trough is still ahead of us, and it calls for a very hard, strong move down up ahead of us. I'm not making trading decisions on the basis of that analysis. And the reason for that is because it's quite an extreme analysis to be making trading decisions on the basis of. When trading using the FLD trading strategy, I always tend to, if possible, go for the default analysis that Sentient Trader is giving me, because I often find that that turns out to be the correct analysis. So as an analyst, I still favor, in fact, the 20-week trough in November, because of course that's the analysis that I'm publishing as an analyst. However, when I'm making trading decisions, I've found that it's best to be just a little more cautious and go for the default analysis that Sentient Trader is providing me with when I'm making trading decisions. And so that's the situation, of course, that we see on this chart. Now, what's interesting is that, in fact, there isn't a great deal of difference between the two analyses. You might think that placing an 18-month cycle trough in November as opposed to a 20-week cycle trough would have huge implications for your trading. In fact, it doesn't, because, of course, trading according to Hurst cyclic principles and the FLD trading strategy is a fairly robust process. Even if we get the analysis wrong, we can nevertheless make correct and profitable trading decisions, and so that's why I'm trading on the basis of this chart. So let me just clear that and show you in a little more detail what this analysis is telling me. First of all, 18-month cycle trough in the middle of November. Then, of course, there was a prominent trough at the end of 2012, this trough over here, which according to this analysis was a trough of the 40-day cycle. Because we saw a good, clear cycle move in that 40-day cycle, that told me to expect that we have a dominant 20-week cycle in the market at the moment. What does that mean? Well, the first thing it tells me is that the next 80-day cycle trough is likely to be subtle, either hidden or straddled. And as you can see, according to this analysis, here is the 80-day cycle, and it was indeed what I would call a hidden trough. You can hardly see that trough in the market. Most people would look at me when I said that's a trough of the 80-day cycle and say, you must be mad, because it doesn't look like a trough of a big cycle. But that often happens when you have a dominant cycle. In fact, it pretty much always happens when you have a dominant cycle moving the market. Then you end up with a subtle trough of the cycle 1 degree shorter. So that played out as expected. What often happens following a subtle trough when you have a dominant cycle is that you will see a straddled trough happening next. And so as the market moved down into this trough over here, I started thinking that was possibly going to develop into a straddled 40-day cycle trough. Now you'll see that according to this analysis, Sentient Trader has placed a 20-day cycle trough at that position. I don't sweat the details too much. I don't get too worried about that. You could debate whether it's a 20-day cycle trough or a 40-day cycle trough. I think it's more likely to be a 40-day cycle trough, but it doesn't affect my trading decisions too thoroughly. So therefore, I'm happy simply to leave that as it is. What is a straddled trough? Well, a straddled trough occurs when, of course, you have the market coming down into the trough, as it did, and then bouncing out in a fairly symmetrical way. And I suppose the key word there is the word fairly. Sometimes you see perfect symmetry in the markets, and in fact, more often than not, you see very, very close to perfect symmetry. Sometimes you see what's happening at the moment, which is not very symmetrical. But if the market turns down now, and that's a big if, but if it does turn down now, then looking back on that, we could say that is a fairly symmetrical price action. Of course, if price goes much higher than it is at the moment, then I would say that's not symmetrical at all, in which case that will turn out not to have been a straddled trough. So that is the situation. That is what I think is really playing out in the markets at the moment. So what is our next trading decision according to the FLD trading strategy? Well, of course, I would go short as price crosses down below this FLD. So that's what I'm going to be doing for the S&P 500. I will be entering a short trade if and when price crosses down below that 20-day FLD. I'll be setting a stop entry order at the level of the 20-day FLD. Now, one or two other small details to point out about this analysis. One of them has to do with the trough at the end of February. Was that a trough of the 20-day cycle or the 40-day cycle? What I often find useful when I'm not sure which of the two it might be is I go back to the previous really obvious trough, in this case the 18-month cycle trough in the middle of November, and I measure the number of bars. And as you can see, there were 101 bars between the trough in November and that trough at the end of February. Now, 101 is an interesting number, and it is a number that you will often see, either 101 or 102 bars. You'll often see that as the distance between troughs. And this is what 101 or 102 bars usually means. Of course, we don't have a cycle which is 101 or 102 bars long. What it usually means is that there has been an 80-day cycle. The average wavelength of an 80-day cycle is, as you know, 68 bars or 68 days. That's the average length of what we call the 80-day cycle. And the average length of the 40-day cycle is 34 bars. When you add those up, you get 102 bars. So whenever you see 101 or 102 bars between two fairly clear and distinct cycle troughs in the market, then that almost certainly means that there has been one 80-day cycle and one 40-day cycle in there. The reason why it's a little bit difficult to really pinpoint this is because the actual position of this 80-day cycle trough, which, as you can see, Sentient Trader, and I haven't pinned that, Sentient Trader's done it by default, the actual position of that trough is a little difficult to determine. Could it have been at that bar where Sentient Trader reckons it was, or might it have been a few days earlier at that trough over there, or even a week earlier at that trough there? Those are all possible positions for the 80-day cycle, and there's no absolutely clear way of saying it definitely occurred on the 4th of February. You could argue that because price at that point came down below the 20-day FLD, that makes it the more likely position for the trough. That would be true, but there is some uncertainty in terms of the placement of that 80-day cycle trough. Nevertheless, whenever you see the number 101 or 102, it usually means that you have an 80-day and a 40-day cycle in there somewhere. And so it is certainly not impossible that this trough over here will turn out to be a straddled 40-day cycle trough, and the price will turn down and come down through this FLD. So that's the next trading opportunity for the S&P 500, is a short trade when price crosses down below the FLD. Now, of course, it's very important to keep an eye on alternate analysis possibilities, and the obvious alternate analysis possibility in the S&P 500 is the analysis that we are tracking in the NASDAQ. So we'll look at it in a moment in the NASDAQ. But the summary of it is that this trough at the end of February, in fact, was a 20-week cycle trough. The only reason why I don't favor that analysis is because this cycle shape doesn't look very good for a 20-week cycle. And so that's why I don't favor this analysis. But it is possible. If that is possible, then the next interaction between price and the FLD will be a B category interaction that we would not want to trade short on. So that's certainly what I'm looking at in the NASDAQ at the moment. So how do I deal with that analysis uncertainty? I deal with it in the way that I always do. I have to make firm trading decisions, yes or no, trade or don't trade. And my decision is that I am going to trade in the S&P 500. If this turns out to be a B category interaction between price and FLD, well, I will get out hopefully with a small loss. And I am going to take the alternative approach in the NASDAQ. So let's take a look at the NASDAQ and see what's happening there. So here is the analysis that I favor in the NASDAQ, which is the alternative analysis that might be playing out in both markets. It's quite possible that this analysis is also playing out in the S&P 500, and if you strongly believe that it is, then of course you shouldn't be taking a short trade in the S&P 500. Highlights for this analysis, very simple, 18-month cycle trough in November. An 80-day cycle trough at the end of 2012, end of December, so that's an 80-day cycle trough, and the trough which formed 2 weeks ago in the market was of course a trough of the 20-week cycle. Okay, so that's the analysis that I believe is playing out in the NASDAQ. Certainly it's the analysis that I'm making trading decisions on the basis of. There have been, as you can see, 13 bars, 13 days since the 20-week cycle trough, which means that the next interaction between price and the FLD is likely to be a B category interaction. Now, as you know, I very rarely enter a short trade at a B category interaction, and I certainly won't in the NASDAQ. So I'm not going to be trading short in the NASDAQ. What is the worst that can happen? The worst that can happen is that price plunges down through the FLD and I miss a trading opportunity. That's not the end of the world. If that does happen, then of course I will adjust this analysis to match the analysis that we're seeing in the S&P 500, and the price action will have revealed the true analysis to us. If, on the other hand, price simply tracks along the FLD, which it might well do if it is a B category interaction, and then bounces up again, then my next trading decision in the NASDAQ will be to enter a long trade for that C category interaction. Okay, so let's just zoom in a little bit and speak about entering into a potential long C category trade in the NASDAQ. What happens when price interacts with an FLD in a B category interaction? That involves price tracking along the FLD. And as you can see, price today, and I'm recording this video before the markets open on Monday, and you can see price is looking as though it's bouncing away from that FLD a little bit. It's certainly reluctant to cross below it. Price might well track along the FLD, and if we see a few bars of tracking along the FLD, or simply a bounce off the FLD, then I will consider entering into a long C category trade. At the moment, the most obvious entry level for that would be the high on Friday. All right, so we're still a little bit away from that, but that would provide us with a fairly obvious entry level. Let's have a look and see whether the 10-day FLD gives us a clear entry level into the C category trade. You can see that in fact it does, but only today. There is the 10-day FLD. So in theory, what we could do is if price climbed up above the level of the 10-day FLD today, then we could enter into a C category long trade. But you will know that of course, is not what we would do using the FLD trading strategy, because we never enter a trade on a Monday within the range of Friday's trading. It's quite an important point. Friday's range, as you can see, was all the way up to here, and so I would not enter into a C category trade at this level over here. That one there. I wouldn't enter into my C category trade at that level. It's quite possible that today price will come up to that level. It might even be sort of stopped at that level, or it might go a little bit above it, and then tomorrow it'll be down below it again, and then we would have a new entry level for our entry into our C category trade, which would be at the level of today's high. But there are quite a few ifs in there. All right, you know the rules for entering into C category trades. C category trades are a little bit finicky in terms of getting into them, but the rules are clear. You use the 10-day FLD if you can. If you can't, then you use a price level entry, and so that's what I will be doing in terms of the NASDAQ. And so you can see how my trading decisions, I can make clear, simple trading decisions, even though at the moment I can't say with absolute certainty which of these two analyses is playing out. And so that's the advantage, obviously, of following the FLD trading strategy, that you can make clear trading decisions even when you have some uncertainty about what the analysis is actually doing. All right, let's take a look at the euro to US dollar. Now, last week I said that I would not be entering into a long trade if price were to rise up to the level of the 20-day FLD. And the reason for that was because I believed that the market was coming down into a 40-week cycle trough. And as the market comes down into that 40-week cycle trough, you need to be careful of double GH interactions. And indeed, that is exactly what happened last week, as I think you can see. On Thursday of last week, price came up to the 20-day FLD, poked its head slightly above that FLD, and on Friday went just a little higher and then came down again to a lower low. Okay, so indeed I was very pleased that I was not trading that interaction. You have to be careful of jumping into your long trades as price is potentially rising out of a long cycle trough. You have to be a little careful. You need to make sure that all the different parts of the puzzle are really adding up, and last week they didn't add up, which is why I wasn't going to enter into that long trade. What about this week? Do all the different pieces of the puzzle add up? Do they all fit together? Not quite yet. Let me show you what's been happening. First of all, we count the number of bars since the most recent 20-week cycle trough, which undeniably occurred in the middle of November. So that was a 20-week cycle trough in the euro to US dollar. There are no options, as far as I'm concerned, for that 20-week cycle trough. And there have been, as you can see, 16.9, almost 17 weeks since then, or 118 bars. Now, the average length of a 20-week cycle is, in fact, 136 bars. So that means that we have about another 18 bars, or almost 3 weeks to go before that 20-week cycle trough is really due. Okay, so about another 3 weeks. Of course, the principle of variation tells us that cycle wavelengths are constantly varying, so it is absolutely possible that that trough could form now. It is possible that that trough formed last week on Friday. It is possible, but we need to be a little careful of jumping to that conclusion. The next bar count that I've plotted on the chart is this one here, 66 days or 66 bars since the most recent trough of the 80-day cycle. And that is most probably the most recent position of the 80-day cycle. You will know from this week's blog posting, the blog that I post on sentienttrader.com on Saturday, I posted a slightly alternative analysis, which positioned that 80-day cycle somewhere in over here, I think, which is not an impossible position for it. So that analysis, of course, tells us that we have a little bit further to go in terms of the currently evolving 80-day cycle. According to this one, we have only another 2 bars to go. So we have 2 bars to go on our 80-day cycle and 18 bars to go on our 20-day cycle. When is that trough going to form? Well, the simple answer is it's most probably going to form somewhere in between 2 bars and 18 bars, somewhere in there. It might have occurred already. And of course, there is the alternate analysis that I published in the blog, which tells us that it is probably going to occur slightly later. So looking at all those pieces of the puzzle, I'm inclined to say that I think I'm going to give the euro to US dollar a little bit of leeway. Okay, let's speak about entering into this A category trade and see whether it's something that we could do easily this week. Let me zoom in a little bit and highlight that FLD. The first thing that is fairly obvious is that price came up to the FLD. In fact, it came up to it on Wednesday. I think it just about touched it. On Thursday, it did what I call tracking along the FLD. It straddled the FLD. The high of the day was above the FLD. The low of the day was below the FLD. And it did the same thing on Friday. All right. And today, it has so far already straddled it. So the high of today, and this is Monday morning that I'm doing this, so there hasn't been a lot of trading yet today, but the high of the trading that we've already seen today is above the FLD and the low is below it. So in fact, price is still tracking along that FLD. All right, although it broke down quite hard on Friday and formed a new low, as I've already mentioned, and potentially formed a trough, in terms of the interaction between price and the FLD, price is still tracking that FLD. So I'm certainly not going to jump into a long trade today. I can't. I don't have a clear entry level. I need to wait until price stops tracking along that FLD. Now, of course, if the trough is still ahead of us and price is still going to form that 20-week or 40-week cycle trough, which is what I expect, then I would expect price to resolve to the downside, which will give us an opportunity to then set an entry level at the level of the FLD. Okay, and so that's that over there. So what I expect to happen is that the euro will probably come down a little further and give us a bit of a gap between price and the FLD, at which point I would set an entry level, a stop entry level at the level of the FLD in the hopes of catching our A category long trade. Now, what happens if price comes up above the FLD today, tomorrow, and sort of fiddles around up above it? Would I jump into a long trade? No, I wouldn't, even though I am expecting the trough of a long 40-week cycle. You can see the nest of lows here. Here's the nest of lows. So you can see visually on the chart we're expecting that trough to form fairly soon. We are not getting a clear entry level. When you can't get a clear entry level, you shouldn't chase the market, in my opinion. So we shouldn't run after it and try to get into this A category trade. If we miss this opportunity, then we've missed it. And we'll look back at it, and at least we won't have made a losing trade. We might have missed the opportunity for making a winning trade, but that's the worst thing that could happen. And in fact, usually what happens when price bounces out of a trough of 40-week magnitude, usually you don't see this kind of tracking along the FLD behavior. Okay, so that is a bit of a warning sign that, in fact, we shouldn't really be getting into this long trade just yet. So we should look for the market to come down a little bit lower, come down a little bit further. As a matter of interest, is it too late to sneak a bit of a profit out of a late H category short trade? No, it isn't too late. So let's speak about that. You must remember that entering into H category short trades is a slightly advanced part of the FLD trading strategy. Getting into H category trades, you've got to be quite quick on your feet, but there is certainly an opportunity shaping up for the euro to US dollar to get into an H category trade for the last sort of move down of price. As it comes into this 40-week cycle trough. Can we use the 20-day FLD? No, we can't, because the 20-day FLD is right on price at the moment. Can we use the 10-day FLD? No, we can't, because it is also being straddled by price at the moment. So the only entry that we have available to us is a price level entry. And of course that would be at the level of Friday's low, so that would be our entry price. And if price drops below that, we could enter into a short H category trade. And what would we use as our pivot point? We would use the high on Friday as our pivot point for the entry into that trade. So that would be our initial stop loss and pivot point, and we would be looking at taking a quick trade down to a T1, which would be over here, and a T2, which would be over there. So there is a potential H category trading opportunity shaping up. It will be a quick in and out trade as price makes its final move down into the 40-week cycle trough. Let's take a look at the British pound to US dollar. The British pound to US dollar, as you know from discussions in previous videos, is in the grips of a very powerful 40-week dominant cycle. And we've been speaking a lot about dominant cycles recently. They are very important in terms of one's trading. And this is an example of what happens when a 40-week cycle has dominance and, of course, is moving down into a trough. Here is the nest of lows. It's a slightly staggered nest of lows, but nevertheless a genuine nest of lows, which implies that this 40-week cycle trough is due in about the first week of April. You will notice that, in fact, this 40-week cycle trough is also synchronous with an 18-month cycle trough and possibly a 54-month cycle trough. I always say possibly 54-month cycle trough, because when you're speaking about those very long cycles, often there are alternative positions for them. And in fact, the position of that 54-month cycle trough doesn't affect anything we do in terms of the FLD trading strategy. All that we are concerned about, or the longest cycle that we're concerned about when trading the FLD trading strategy, is the 18-month cycle. So whether or not this is going to be a trough of 54-month magnitude is not terribly important to us. What is important, of course, is that it will be a trough of the 18-month cycle. So last week I said I'm not going to be entering into any trades in the British pound to US dollar, and the reason for that was because the 40-week cycle is really pressing down very hard in the final days as it comes down into this 18-month cycle trough, and it's very hard to get into trades as markets are heading down so fast into their troughs. What we would want to do probably, of course, is catch the bounce out of this trough, which would occur, of course, after the trough is formed. We would enter into a long trade at the level of the 20-day FLD. Will I be jumping into that this week? I certainly would consider it, although this week is still a little bit early to my mind. As you can see, there have been only 42 bars since the most recent and most likely trough of the 80-day cycle, which means that we are expecting another 26 bars. So 3 or 4 weeks before that major trough forms. Okay, so I'm not going to be setting my stop entry orders yet on this 20-day FLD. I'm going to be just a little more cautious about it. Of course, the position of this 80-day cycle trough over here could be debated, and there are various other positions for it. In particular, in the week that followed that, in the first week of February. All that would imply is that we have even longer to wait before the formation of the really big 18-month cycle trough. Now, what about the FLD and price interactions that have followed this 80-day cycle trough? They make for a very interesting lesson because, as you know, when we have a very powerful, longer dominant cycle, the interactions between the FLD and price become very distorted. And so here we do have clear interactions, although they are very distorted. And so let's zoom in and see if we can identify in this very distorted price movement the FLD and price interactions. The first thing that you do, of course, is you have a look at what price is doing relative to the FLD. So here's the first interaction over here as price came up to the FLD. That is our A category interaction, assuming that this is the trough of the 80-day cycle. That is not a very typical A category interaction because we usually expect A category interactions to achieve their targets, of course, which would have been up here. That would have been our T2 target for that A category interaction. Why is that an atypical A category interaction? Because of the dominant cycle. All right, what's the next thing that happens? Well, usually what happens is the price comes back down to the FLD, and round about the 20-day cycle trough, it forms the B category interaction. Well, here, because price didn't even get away from the FLD, that is quite difficult to identify. But we can probably identify a little bit of a B category interaction over here. Then, of course, price breaks back up again, and that's our C category interaction. Here there was, in fact, a price cross of the FLD, and so that classifies as our C category interaction. We expect that to be round about the trough of the 20-day cycle. Where's the trough of the 20-day cycle? Well, according to this analysis, it's over here. So that doesn't look quite right. But again, that's what tends to happen when you have a very powerful dominant cycle. And the identification of that 20-day cycle trough is quite difficult. And so we can't expect the picture to look perfect. But nevertheless, we have a series of 3 interactions which we could call our A, B, and C category interactions. What happens next? Well, price comes down through the FLD in a D category interaction, which is most probably this interaction over here. And indeed, price was coming down to form the 40-day cycle trough. Now, here is the 40-day cycle trough according, again, to this analysis. And again, I must point out that the identification of troughs in a market that is falling with this kind of speed is a very difficult thing to do. Is that the 40-day cycle trough, or was it over here, or was it over there? Or is it still forming now? It's not impossible. There have been only 42 bars, as you can see, since the most recent 80-day cycle. And so it's not impossible that the 40-day cycle trough hasn't formed yet. We do have another interaction with the FLD, and that was last week. On Tuesday of last week, price came back up to the FLD, touched it, and then dropped away again. Is it possible that is our E category followed by our F category interaction? Yes, it is possible. And again, the reason why the sequence is so distorted is because of the very powerful dominant cycle. It makes for a very interesting lesson in terms of what happens. Our FLD interaction sequence doesn't disappear when you have a dominant cycle, but it does become very distorted to the downside. And if we had been interested in trading the British pound to US dollar last week, then we certainly could have traded short on the basis of price interacting with this FLD. We could have faded that price interaction with the FLD because we knew that there was a dominant cycle pressing downwards, and any interaction with the FLD was pretty much doomed to be a bearish interaction, as I mentioned last week. I choose to step aside because when you have such a powerful dominant cycle, the FLD and price interaction sequence gets distorted almost beyond recognition, and it does become very difficult making trading decisions. I prefer to make much simpler trading decisions. And I prefer to simply say I'm not trading this market at the moment, which is what I've done with the British pound to US dollar. And I'm going to wait until the picture becomes clearer. But of course, if that was our F category interaction, what do we expect next? We expect a G category interaction followed by an H category interaction. Do we want to trade our G category interaction? No, we don't. But what we might want to do is take the opportunity to enter into a short trade when price does come back up to that FLD and catch the final part of the move down in an H category short trade as the market finally moves down and forms this 18-month cycle trough. So if price rises up to the FLD again this week, then I will not be entering into a long trade in the British pound to US dollar, because I think that is slightly premature, but I will be looking for an opportunity to get into an H category short trade using the rules that we use for defining entries into H category short trades according to the FLD trading strategy. Thank you for joining me in the Hurst Trading Room today for the 11th of March 2013. In a separate video, I'm going to speak about the trading opportunities that are present at the moment in soybeans. Soybeans are really interesting because I believe that one needs to perform an inverted analysis involving peaks as opposed to troughs in the analysis, and that's going to be the topic of today's separate trade opportunity identification video. I look forward to seeing you again next week in the Hurst Trading Room, and I wish you profitable trading.